or good evening, traders and friends right around the world, market enthusiasts also. It is James on behalf of Pivot Point Trading bringing you this very important Tuesday afternoon market recap. I wasn't on the airwaves yesterday, although we did see quite a promising rally to the upside. The Dow Jones Industrial Average itself closed up just over 300 points, left us with a really nice long day Moroboshi type of candlestick. However, today, as at the close on Tuesday, we are left with a very, very small spinning top kind of candle. Now, what's so important about this particular candle as at the close on Tuesday is that if I change to the exponential moving averages, you can see that it is the first legitimate time since the month of July where we have come back up and retested, or at least price has moved into that 50 exponential moving average. What I've done, I've just zoomed out, and this is the beginning of July right here. You can see July 2015, and only for really 5 trading sessions, we crept above the 50, but ultimately failed. Since then, you can see what price has been doing. It's been selling off, and then we're seeing these very small bounces, either back up into the 10, the 20, or the 50 exponential moving average. And as time progresses, I'm trying to color coordinate this. Red is the sell-off, and green is the bounce. You can see whenever we influence or interact with the 10, the 20, or most noticeably now the 50, we're seeing some form of a bearish reaction. All right, very, very interesting to note, because essentially price is still below the 50 exponential moving average. It is the first time that we have closed above it, or for the second trading session, but it isn't enough to warrant a buy signal in and of itself. Generally, what will happen is that the trend itself is in a bearish direction. Price has been below the exponential moving averages. It has also been below the 100 and the 200. This has really taken off from since the capitulation in August. Right now, we're going through a phase where price itself is coming back up to retest differing levels of resistance, whether it's the 50, let me just change my color, whether it's the 50 here, or it's the 10 or the 20 exponential moving average. Whether or not we break above it, what happens next? We've got overhead resistance in the format of the 100 or the 200 simple moving average, let alone the macro support, which is now turned resistance, which all comes in just above 17,210. What I'm trying to explain to you is that the trend direction as it stands is still in the favor of the bears. We do get these little minor level retracements and these little minor level bounces, but what happens is they bounce back up into these declining areas of resistance, and then it ushers in the next wave or the continuation of the bigger trend direction. At the moment, and for the better part of 2015, or as it started at least, we were still in a bullish primary trend. What I mean by that is price itself, it was still making a series of higher lows and also higher highs. It wasn't really until March 2015, at least on the Dow Jones Industrial Average and also on the S&P 500, where we really started to stagnate and start moving sideways. This produced really an abundance of false breakouts, or what we call whipsaws. You can see all these little whipsaws where we sort of poked our head above resistance levels, but very, very quickly the bears came in and started selling into these false bullish breakouts. Since that point in time, and again, since really June, where we started to see the beginnings of these lower lows and at least the continuation of relative highs or even lower highs, we're starting to see what was, again, at the beginning of 2015, a largely bullish primary trend potentially turn into where we are now, where we're asking ourselves the question, is this the beginning of something much more sinister and something which is going to move the future expectations of price, or at least 2015 into 2016, lower in terms of the primary trend reversing? These are the types of stages, or at least the technicals, that we're really trying to delve through at the moment and come to any form of a conclusive sort of outcome as to where the future direction of price is going to move. What I'm trying to say to you right now is that we are sort of in no man's land. We're at some form of a short-term pivot point. It's not a long-term macro point or macro pivot point. So we're not as if we're trading back at these old support levels, which are now resistance up around that 17,250. All we're doing right now is we're sort of touching around that 16.8 level, back to that little Fed intraday reversal dating back to the tightening of the monetary policy by the Fed when they had the open FOMC meeting on the Thursday, dating back a couple of weeks ago. We're coming back to where this shooting star was We haven't closed above it, but right now risk is on definitely for anyone opening up short-term or even long-term bullish positions, given the fact that we're not actually in any form of a bullish move or in a bullish trend at the moment. As it stands and as the technicals are telling us right now, we are once again in no man's land. When we find ourselves in no man's land, or when we find ourselves at a very important pivot point where it's very neutral which way this market can move, generally you like to set up bi-directional trades if in fact they set up. But if you're not comfortable with that and you do not have an overwhelming majority in terms of probability as to which direction the market is going to move or which direction you expect it to move outside of the technical picture, it's best just to sit on the sidelines and wait for the most opportunistic time to start entering again into the market or setting up these contingent orders on individual trades. Right now, once again, the market itself is confused. It is shown by this spinning top right here, this little small wave spinning top that you can see on the Dow Jones Industrial Average. You also see this is more so an inside day harami. It's still a spinning top, a little bit different. The candlestick itself is dark. The reason why is because on the S&P 500, it was actually a negative day, only down 7 points, not a lot, of course, in the face of such a bullish movement, which took place on the Monday. But again, a spinning top, reflecting indecision. If I bring it up, look where it's occurring, right at that 50 exponential moving average. The only really major difference between these three markets is that of the NASDAQ. And the only difference really is the fact that we've come back down and we've closed the open window, which set up between Friday's and Monday's trading session. In and of itself, once again, it's not giving us really all too much new information. You can see that price is below the 10, the 20, or so not below the 10 and the 20, but definitely below the 50. And as it stands, this isn't very much so an environment for bulls, right? At this point in time, the trend itself is down and making lower highs. We failed to make a little macro swing low here, but on the time scale, and especially working with these exponential moving averages, when price is below at least the 50, you're generally in a bearish type of move or a bearish type of environment, which definitely rewards bearish trade setups. And when price is above the 50, as it is probably 90% of the time in the market when you see price above the 50, it's a very good indication at least that price is going to continue high. You tie that into the primary trend again, which I haven't really touched on, but I have referenced in this little Tuesday afternoon market update, and you get a very clear picture at least of where price is moving. Just to recap, at the moment, we're going through some form of a transitional type of period. It is still largely unknown where we will be in maybe 3 months' time, but I will say this. Pay very close attention to the 200 simple moving average. This is what I'm paying attention to. This is why I have a red box drawn on my screen on the Dow Jones, the S&P, and the NASDAQ. If and when the market does push up, and it probably will sooner rather than later, definitely before the end of 2015, very, very intelligent position to be taking out some form of a bearish hedge on the market, whether you want to open up positional puts or just get into some inverse ETFs on the market itself, which will open up opportunity if in fact the market itself reverses from this location up here. That is probably one of the smartest trades you can do for the year 2015, given the volatility which we are seeing, and price itself again remaining below a lot of these very bearish, ominous warning signals which haven't really set up since the beginning of the 07-08 bear market, and also at the end or at the beginning of the millennium where we set up and crashed through the dot-com era. Very similar signals, which I'm not going to walk through with you now. I just simply do not have enough time, but you can check out divergence. Very important signal right here. You can have a look at what happens when we start establishing lower lows and lower highs, and what happens on the first bounce back up to the 200 simple moving average. That is a big, big giveaway signal. And then once you get established in some form of a correctional type of market, just pay attention to that 50 exponential moving average on the daily time frame. You can do some weekly analysis also, but at the moment, it doesn't matter which way you break down this market. There isn't any conclusive evidence whatsoever to say that the bull market is continuing, and vice versa, or at least the polar opposite of that statement, to suggest that the bear market is getting started right now. We're going through some formal transitional period right now. It'll shake out. We'll soon be able to see, given what the technicals do at certain areas. But where we closed at, again, just to recap on Tuesday, is that we are at that 50 exponential moving average. There's a good chance that we just flat out see rejection here. We see some form of a bearish 2-day candlestick pattern, which may usher in a sell-off back down to our ultimate price target, which I've had on my chart for a number of months right now, 15,638. And maybe once we hit this is what I assume will happen if we do. Doesn't matter. It doesn't mean that it has to. But if we get down to here Then we will start the legitimate slope of hope, a type of rally which inevitably generally fails at that 200 simple moving average. There's really one of two scenarios which I'm looking forward to, or not so much looking forward to, but at least anticipating. That's a better type of word or definition. Anticipating these either two types of scenarios, the sell-off down to our target or either the bullish bounce up into the 200. And again, very smart location long-term to be setting up either a bearish hedge, a directional trade using puts, or at least having exposure in an inverse ETF, which will work inversely to market direction, which will be able to offset at least some of the long-term positions which you may want to hold or may choose to hold during what could be very violent times across all three of the US markets and also on the global financial markets as well. We haven't seen this type of movement since 2011. Pardon me. There's my chesty cough again. But again, I'll bring it to your attention as it unfolds. There just hasn't really been all that much to speak about until now, where we have legitimately, once again, prices come back up to that 50, that declining 50 exponential moving average, generally rolls over at this location. So do not be shocked whatsoever if the direction of the trend, the stream of the market itself continues in the downward direction back down to our target before we set up a legitimate slope of hope. If you see a legitimate slope of hope rally set up over anything longer than 3 to 4 months, there's a very good chance once again that this is really the last right shoulder of the market. And what follows or what ensues after that right shoulder is absolute mayhem. All right. So just keep that in mind. If you have any questions whatsoever, email me success@pivotpoint-trading.com. I don't want to sound overly bearish right now, but I'm not in any bullish trades, nor am I in any bearish trades. 100% neutral right now. Just waiting for the right opportunity to enter into the market. I'll monitor price action on Wednesday. See if it looks as though this market wants to move lower. If that is the case, I'll be looking for individual trade setups. I will finish on this, for instance. Walgreens Boots and Alliance has been a trade which we have followed since its rollover in this red box. A really nice trade a couple of weeks ago. Very interesting 3-day pattern which has just presented itself. This is what we call an evening star reversal. So as the market itself moves into that declining 50 exponential moving average, as it is doing right now, and it's saying to us, look, this may well potentially be a very good opportunity to short the market. We see, for instance, in Walgreens Boots and Alliance, a very, very bearish 3-day candlestick reversal pattern at the right location, again at that declining 50 exponential moving average. So pay attention to these types of signals which you see in individual trades. Tesla, again, a little bit of volatility coming back down very close to that 234 entry. Outside of that, I mean, I can cover all of these shares. It really goes against this, or what I was hoping to do on this Tuesday afternoon. CVX has been the only other stock which is essentially broken out. I did not take the trade. I made it very clear. But I know some people did, and I don't want to mention any names, but they actually got in on this candle right here Thursday last week, and it's worked out very well for you. I just want you to understand that that is a trade against the direction of the trend. The trend is down again. You can see long-term what's happening, not only on Chevron, but also on Exxon Petroleum and a few other major oil companies, let alone all of them really, given the price and volatility of oil. But this was up very close to $3, $2.96. I'm going to leave it there. I don't want to cover anything else. It's just taking too much time. This is simply meant to be a Tuesday afternoon YouTube update. So have a fantastic evening. If you have any questions whatsoever, email me, success@pivotpoint-trading.com. All the best traders and friends right around the world. It's James signing off on behalf of Pivot Point Trading. Goodbye.